Fiscal deficit usually occurs when the expenditure of the government, that actually includes the total interest paid on the government debt, exceeds the revenue of the government. So when I say fiscal deficit, it is basically comprised of two things. One is revenue deficit, and also when there is a hike in the capital expenditure. Usually capital expenditure hike might arise when the government is planning for a long-term projects. So also the revenue deficit, when I say about it, includes the non-debt capital instruments receipts as well. So in the meantime, we actually see how these two things actually impact the cost of borrowing. So here in this graph, we see that in the last 5 years, the fiscal deficit actually decreases substantially from 4.5% of nominal GDP right now to 3.5% in the last year 2016-17. Whereas in this 5 years, in the same period, the GDP has been increasing at a constant rate of 6 to 7%.
Fiscal deficit may occur either due to increase in the expenses like government non-capital spending in the form of subsidies, direct benefit transfers, or in the form of policies like Mannarega, or either due to plumbing also, where it invests into the economy in the form of developing infrastructure and other things. Or also it may be due to decrease in revenue, which is by stimulation packages like decrease in taxes, cess, surcharges, etc. This all leads to crowding out effect and also cyclic effect also. Either we can say that fiscal deficit increases borrowing costs, which in turn increases the interest rates in the economy, and which in turn creates much more difficult for the fiscal deficit increase. To borrow in the future also. So but when we see the current market trends in the current fiscal deficit trends, we can say that there are low borrowing costs, at the same time increase in the fiscal deficit in the terms of the nominal values. So it implies that government is currently increasing its plumbing into the economy by developing the infrastructure and not concentrating on the non-capital expenses.
There are three ways of financing the government deficit. One, through external financing. The second, through the market borrowing. Third one, through monetization of the debts. Speaking of the market borrowing, let us speak about the impact of market borrowing on the bond yields. First thing, if government borrows more money from the market, the liquidity risk increases, since the money supply in the economy will be decreased. So that in turn will increase the bond yields. The second thing, like I said, the money supply in the economy will be decreased, which will shoot up the interest rate. And third thing, if money available in the economy is pulled up by the government for funding the deficit, the money available for private investment will be reduced, and that in turn will affect the investment. However, there is one advantage with the market borrowing. When government plans to borrow money in the market, it has a flexibility to borrow it the longer maturity durations. It need not depend on the outside market for a fixed maturity period. For example, this time it plans to borrow the funds from the market at 14.7 years of maturity. The last thing, if you see this graph, the particular graph, as the market borrowing and the total gross fiscal deficit is related inversely. Go.
The second major component of internal financing, that is monetization of fiscal deficit, has two components. First, the RBI prints more currency to help fund government fiscal deficit. Second part is government can alter its cash balances kept at banks. So, if you see the trend in monetization of fiscal deficit, it has been an increasing one, except in 2012-13 when government added to its cash balances at RBI. Now coming to the impact of monetization of deficit. Since RBI prints more currency, it leads to expansion of money supply in the economy, which leads to higher inflation. Since inflation rises, real interest rate falls and capital outflow from the country increases, which leads to worsening of capital account. Since prices also increase with inflation, people's tendency to import increase and current account worsens. Both of these lead to deficit in BOP deficit and currency depreciation. For external financing part, an increasing trend has been observed over the past few years, with a steep increase observed in 2014-15 compared to 2013-14, where external financing almost doubled in its amount. The impact of foreign borrowing. since foreign borrowing is usually shorter, the maturity term is shorter compared to domestic borrowing, government has to pay higher liquidity premium. Also, if the bonds are denominated in foreign currency, a credit risk premium needs to be paid. If the bonds are denominated in domestic currency, foreign exchange premium has to be paid. Overall, borrowing from foreign investors is much more costlier than domestic borrowing. Since there is a net capital outflow from the country because payments, principal and the interest needs to be paid out, it affects exchange rate and balance of trade in a negative way.
Go.
Yeah, so we had two hypotheses. The first one was that the cost of borrowing will rise with the rising fiscal deficit, and the second hypothesis was that if the fiscal deficit was met with increased liquidity, then in that case the interest rates would not rise with the rising fiscal deficit. So to give the rationale to that hypothesis, first we looked at it from the point of demand and supply of government securities. So if in case the government goes into the market and issues more securities to finance the fiscal deficit, then in that case the supply of government securities would increase. So this would result in a fall in price of the government securities, which translates into higher cost of borrowing for the government. Secondly, if there is persistent borrowing on year on year, then the debt to GDP ratio of the country would increase. As a result, it might be more risky to lend to the government. So hence the investors would be little speculative about investing in the government securities, and hence the demand for government securities would decline. So a decline in demand for government securities would further decrease the price of the government bonds. This fall in price would correspond to a increase in cost of borrowing for the government.
Now, as we already discussed, if the monetary policy is unaltered, the rise in fiscal deficit will cause a rise in interest borrowing, cost of borrowing. So now we'll see the crowding out effect using the ISLM model. So what happens is when the government goes for fiscal expansion, the IS curve shifts to the right. So the new equilibrium point so obtained will give a higher real interest rate, which will mean that the cost of borrowing will increase for the government. Now, because of this increase in real interest rate, the private investment will be drawn out. That is why this is termed as crowding out effect. Now, one of the essential assumption here is that the prices are sticky, as well as that the monetary policy is unaltered. So what happens if the monetary policy is also altered along with the fiscal expansion? In that case, as the because of the monetary expansion, the LM curve also shifts to the right, which will result in a new equilibrium point. So the equilibrium will move from E2 to E1, causing a fall in real interest rate, because of which the real interest rate may remain unaltered.
Coming to data collection, so we had to select the proxy for cost of borrowing for the government borrowings. So first we selected government securities which represented both short-term and long-term requirements. So for this we selected 1 year, 5 year and 10 year government securities. For the cost of borrowing, we selected the market yields for these securities. There is an issue related to selecting market yields, which is that yields show a lot of volatility on day-to-day basis. So yield rate cannot be on a particular day cannot be taken as a proxy for cost of borrowing. So we averaged it out over the entire period so as to come up with average cost of borrowing for the entire year.
So the first thing that we had to decide on was the proxy for the cost of government borrowing. There were three possible candidates: the 1 year yield, the 1 year treasury yield, the 5 year treasury yield, or the 10 year treasury. So what our process involved running regressions against all of these three as the dependent variable against the fiscal deficit. So the first regression involved running these three yields against just the fiscal deficit. The results were both unexpected in the sense that the signs, which was expected to be positive, was negative, and they were also insignificant. This could be explained by the fact that fiscal deficit numbers are nominal. They don't take into account the size of the economy, they don't take into account the change of prices. So a more appropriate figure would be the fiscal deficit scaled against GDP, or the fiscal deficit to GDP ratio. So the next step in our regression was to regress this ratio, fiscal deficit to GDP ratio, against the three benchmark yields. This is a preliminary scatter plot of the four figures that we're talking about. The three benchmark yields are the red, green and blue lines on top, and the fiscal deficit to GDP ratio, it's the volatile line over here, is shown below. Everything is in percentages. If we notice, the period before 2011 showed excessive volatility, whereas the period past after 2011 is fairly smooth.
So when we zoomed into the 2011 to 2017 timeline, when we ran the regression over this period, the results were still insignificant. But what we see is that the regression results were on the expected lines, and also the R-square improved a lot compared to the previous regression results. This means that the regression equation was a good fit as compared to the previous equations. Now, one of the reasons because these results were insignificant could be endogeneity. Now, we know that economic outlook is correlated with the yield as well as fiscal deficit, and this factor is very hard to capture. So this could lead to inconsistent, biased and insignificant result. Now coming to the conclusion, now as we see the scatter plot over the last 6 years, we see that the fiscal deficit is falling as the yield is falling as the fiscal deficit to GDP ratio is falling. So this could entail that as there is a prudent policy followed by the government, if the fiscal deficit falls down, the cost of borrowing will come down. And we see an anomaly in the period of 2013 when the Fed announced tapering of quantitative easing, and as the market was expecting such an announcement, this led to the spike in the yield. And also one last conclusion is we see that the yield curves are normal with shorter duration bonds having a low yield and higher duration bond having a high yield. Thank you.
We see that there are several proposed targets in order to reduce the fiscal deficit of the government. The fiscal deficit has been pegged at 3.2% of the GDP for the financial year 2017-2018. The FRBM committee has recommended a debt to GDP ratio of 38.7% for the central government, 20% for the state governments together, and a fiscal deficit of 2.5% of the GDP by the financial year 2022 to 2023. There are several ways by which we can reduce the fiscal deficit of the government. This can be in terms of reduction of government expenditure, increase of revenue of the government, sustained economic growth, as well as certain institutional reforms. We can reduce the government expenditure by providing lesser subsidies on items such as fertilizers, exports, electricity, etc. We can also reduce the interest payments on the past debt. So we believe that the funds that are obtained from disinvestment in the public sector should be used majorly in order to retire off the past debt rather than financing current expenditure. The increase in revenue of the government can be brought about by increasing the taxation revenue. For this, we follow a policy of moderate taxes with simplified taxation structure. Also, we aim at improving the tax base so that we can include agricultural income and other unorganized sectors, as well as commodities in order to increase the tax net. There should be restructuring of the public sector enterprises so that the surpluses that they are producing should be used for their own development, such that their dependence on the government's budgetary resources can be done away with. Also, there should be enactment of a new Debt and Fiscal Responsibility Act and a new Fiscal Council, because the previous act had proved to be ineffective. It was done away with in 2009, and then the fiscal deficit had totally gone out of control. However, there are certain challenges in order to implement these ways to reduce fiscal deficit. There is certain uncertainty around the commodity prices, especially that of crude oil. If the crude price breaches and sustains over $60 per barrel, unless the government refusing to lower the duties, it will hurt their revenue collection. Also, if there is a likelihood of the existence and persistence of a global slowdown, the fiscal deficit of the government will go down because the taxation revenue will be reduced and they will have to provide certain welfare schemes to the citizens.